Over the last 9 episodes, we have mapped the architecture of global wealth, the trusts, the treaties, the holding structures, the jurisdictional layering that the world's most insulated families use, not as secrecy, but as sovereignty. We have watched this system survive currency crises, government collapses, tax amnesties, and the slow creep of international reporting frameworks that rewrote the rules beneath the feet of those who were not paying attention. And now we arrive at the question that every serious investor in this series has been asking since episode 1. What is the final structure? Not the component parts, those you already understand. The final integrated model, the structure that closes every gap, bridges every jurisdiction, and endures every cycle. That is what this episode answers. Before we build, we must understand what has changed, because the pressure on private wealth today is not tax, it is not reporting, it is governance. The real threat is the creeping reassignment of control, where the beneficial owner gradually becomes a managed participant inside their own structure, where the family office becomes beholden to custodians, compliance officers, and foreign regulators who determine what can move, when, and at what cost. What you are seeing here is the governance inversion, the point at which traditional offshore structures began drifting from private control toward institutional dependency. The vertical axis represents control retained by the principal. The horizontal axis represents time. Notice the inflection point, 2010. That is when the Foreign Account Tax Compliance Act, commonly known as FATCA, was signed. From that moment, the era of passive offshore compliance ended, and the era of active structural sovereignty began. The families who understood this did not retreat from structure. They redesigned it. What they built is the model we now examine. Geography is not a background condition in sovereign wealth structuring. It is an active strategic variable. And yet, most wealth advisors treat it as a formality, a checkbox, a mailing address, a line on a trust deed. That is a fundamental error that has cost high net worth families hundreds of millions of dollars in unnecessary exposure. The question is never simply, where do I domicile? The question is, which geography offers me the most favorable intersection of treaty access, political stability, currency convertibility, judicial independence, and institutional depth? Those 5 variables rarely align. When they do, the result is what we call a strategic jurisdictional anchor. A geography that functions not just as a legal address, but as a structural asset in its own right. There is one such geography that in the current global configuration satisfies all 5 criteria simultaneously. South Africa, specifically Cape Town. We have discussed this market in prior episodes, but here we present the complete strategic case for why it functions as the southern anchor of the sovereign shelter model. What this map illustrates is not real estate. It is jurisdictional geometry. South Africa holds 54 bilateral investment treaties. Its courts operate under English common law precedent. The rand denominated asset base allows high net worth principals from the United States, Europe, and the Gulf to acquire significant physical and financial positions at deep currency adjusted discounts relative to equivalent assets in London, Zurich, or Singapore. Cape Town specifically offers a combination that is at present genuinely rare: a Tier 1 legal infrastructure housed inside a Tier 2 cost structure, a fully convertible currency, a property rights regime anchored to constitutional protections, and a geographic position at the southern tip of Africa that places it within both the African Continental Free Trade Area and the orbit of Indian Ocean Basin trade flows. This is not an emerging market. It is a mispriced sovereign asset. And the families who recognized this quietly between 2015 and 2023 are now sitting on structural positions that cannot be replicated at 2015 prices. Now, we construct a vehicle. The sovereign shelter model is not a single entity. It is a multi-tier trust structure layered not for complexity, but for resilience. Each tier serves a distinct function. Each tier is jurisdictionally independent, and each tier is designed so that the failure, seizure, or reporting obligation of one tier does not cascade into the others. Tier 1, the Foundation Trust, domiciled in a stable treaty-rich jurisdiction, Mauritius or Jersey for those originating from Africa and Europe, the Cayman Islands for those with United States nexus. This trust holds no operating assets. It holds ownership interests. It is the constitutional layer of the structure. It defines beneficial entitlement and succession without generating reportable income at the trust level. Tier 2, the operating holding company. A private company, typically a Mauritius global business company, or a South African private company, depending on asset class, through which operating investments, real property, and liquid asset portfolios are held. This is the transactional layer. It generates returns, carries liabilities, and interacts with banks, counterparties, and regulators. But it does so under the ownership umbrella of Tier 1. Tier 3, the liquidity reserve. A segregated vehicle, either a protected cell company or a private investment fund, holding $500,000 to $5 million in fully liquid multi-currency assets. This is the operational reserve. It ensures that no liquidity event at the principal level ever requires the unwinding of Tier 1 or Tier 2. There is a distinction that separates institutional wealth advisors from the merely competent. It is the distinction between compliance and control. Compliance means your structure satisfies current regulatory requirements. Control means your structure retains decision-making authority regardless of what those requirements become. The Common Reporting Standard, the CRS and FATCA, have created a world in which financial information flows automatically across borders. This is a reality. It is not going away. The uninformed response to this reality is to eliminate offshore structures entirely, to consolidate assets domestically in the belief that simplicity equals safety. That is precisely wrong. Consolidation under a single jurisdiction concentrates exposure. It does not reduce it. The informed response is to build a structure in which full compliance and retained control coexist. A structure in which everything that must be reported is reported correctly, strategically, and in a manner that creates no trail from the reporting obligation to the beneficial owner's operational footprint. That is what this architecture achieves. One of the most underappreciated design problems in multi-jurisdictional wealth structures is the liquidity bridge, the mechanism by which capital moves between tiers, jurisdictions, and asset classes without triggering adverse tax events, regulatory holds, or currency conversion penalties. What this schematic illustrates is the flow architecture we deploy in the final sovereign shelter model. Capital enters at the Tier 3 reserve layer, typically via a loan facility, a management fee arrangement, or a dividend from the operating holding company. It is not extracted. It is repositioned. The distinction matters enormously under both South African Reserve Bank exchange control regulations and the OECD's base erosion and profit shifting framework, commonly called BEPs. The bridge contains three critical design elements. First, the intercompany loan facility, denominated in a stable reserve currency, typically United States dollars or Swiss francs, with a commercially justifiable interest rate that creates a deductible expense at the operating company level. Second, the management services agreement, a legitimate documented arrangement that transfers operating profit upstream to the Foundation Trust in the form of a fee rather than a dividend. Third, the currency hedge, a forward contract or option structure held inside Tier 3, which insulates the reserve layer from rand volatility without requiring capital to leave the structure. The structure we have described so far addresses asset ownership and capital flow. But there is a third dimension of sovereign shelter that is rarely discussed in public forums because it is the most operationally sensitive: the shielding of the principal's personal footprint. Beneficial ownership registers are proliferating. In the United Kingdom, in the European Union, in Mauritius, and now with the Corporate Transparency Act in the United States of America, what these registers do in aggregate is create a global map of who owns what. The question is not whether your structure appears on this map. Under current law, aspects of it will. The question is, what does the map reveal and what does it conceal? The answer lies in directorships. in nominee arrangements, in the use of licensed fiduciaries, professional trustee companies that appear on the public register in place of the beneficial owner. None of this is evasion. All of it is standard institutional practice at the $50 million and above level. The difference between a family that uses it correctly and one that does not is ultimately decades of compounded privacy. Transparency is the political word for involuntary disclosure, and the international architecture of involuntary disclosure has never been more advanced. The OECD's Global Forum on Transparency and Exchange of Information for Tax Purposes now covers 163 jurisdictions. The Financial Action Task Force, the FATF, is expanding its definition of beneficial ownership to include indirect control rights, trust protectors, and discretionary beneficiaries. The European Court of Justice has issued rulings that directly threaten the confidentiality of professional trustee arrangements in EU member states. This is the operating environment. It is not hostile to structure. It is hostile to amateur structure, to legacy arrangements that were built for a prior era and have not been updated. The sovereign shelter model is designed for this environment. Every reporting obligation within it is anticipated, documented, and managed. There are no surprises, because surprises in this context are existential. Every structure eventually faces an exit event, a principal death, a forced liquidation, a jurisdictional change, a geopolitical disruption that makes one leg of the structure untenable. The sovereign shelter model anticipates all of these, not by trying to prevent them, that is impossible, but by designing each tier so that it can be dissolved, migrated, or restructured independently without triggering a cascade failure across the whole. This is the complete integrated model. What you are seeing is not a diagram of ownership. It is a diagram of optionality. At every tier, the principal retains the ability to exercise a sovereign exit, to migrate the foundation trust to an alternative jurisdiction within 90 days, to liquidate the operating holding company and repatriate assets through the Tier 3 reserve layer with minimal tax leakage, to transfer beneficial interests to the next generation through a mechanism that does not require probate, does not trigger estate duty in the domicile jurisdiction, and does not surface on a public inheritance register. The exit is not a failure of the structure. The exit is the structure's final proof of quality. And the families who have built this model correctly will exit cleanly in any direction, on their own timeline, under their own authority. In episode 1, we asked a single question: why do the wealthiest families in the world behave differently with money than everyone else? We examined the foundational premise that institutional wealth is not simply large personal wealth. It is structurally different. It operates under a different set of rules, a different set of instruments, and a fundamentally different relationship with time. Over 9 episodes, we mapped the evolution of that difference. We traced the origins of the sovereign trust from its medieval English roots to its modern Mauritius incarnation. We examined the mechanics of bilateral investment treaties and how they function as private legal guarantees for the principal who knows how to invoke them. We dissected the offshore holding company, the private placement life insurance wrapper, the family limited partnership, and the private trust company. We studied the shift from Swiss banking secrecy to the new architecture of distributed jurisdictional control. And in each episode, we return to the same underlying principle. Sovereign wealth is not about hiding assets. It is about owning them in the most structurally resilient configuration available under current law. That principle has not changed across 1,000 years of wealth preservation history. Only the instruments change. The principle is permanent. The structures we have described in this episode and across this entire series are not static. They will evolve. The geopolitical environment will shift. New treaties will be signed. Old ones will be renegotiated. A new global minimum tax regime will reshape the economics of certain holding jurisdictions. Technologies, digital assets, tokenized real property, programmable compliance infrastructure will introduce instruments that do not yet have a name in the regulatory lexicon. The families that endure are not the ones who found the perfect structure in 2024 and held it unchanged through 2044. They are the ones who built a structural philosophy, a set of principles about sovereignty, optionality, jurisdictional diversity, and generational continuity that allows them to adapt any specific instrument while preserving the underlying architecture. That philosophy is what this series has been transmitting. You now hold the complete framework, the foundational principles, the jurisdictional logic, the structural tools, the integrated model. What you do with it, how precisely and how urgently you apply it, is the only remaining variable. The era of passive wealth management is over. What begins now, for those who have absorbed this material fully, is the era of sovereign ownership, not as an aspiration, as a structural fact. This is not the end of the series. It is the beginning of the application.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.